invite Yogesh Gaba, Managing Partner for Gaba and Company. Please welcome him on stage with a huge round of applause.
So hi everyone. So I think there are already 3-4 sessions on technology, artificial intelligence, softwares, and people say you will get your life sorted 70 to 90%. So the government also thought about their officer, and now you have seen that your life is already damaged to 100%. So artificial intelligence of course can help, technology of course can help, but we are going to discuss certain topics and certain practical issues which can only be sorted out by application of human mind, not the robot mind. So starting with the first issue, which is very pertinent with respect to changes in the 3B format, return format. So in I think August 2022 or from September 2022 they brought in this format to say that now you claim the entire input tax credit which is reflected in GSTR 2A, then you make a segregation in two parts for reversal. So you segregate into permanent reversal and you segregate into temporary reversal. For temporary reversal you can mention that it will be claimed in future periods, okay. And for permanent reversal, these are the reversals where you cannot reclaim the input tax credit. So my question to you is, for example, you have reversed certain ITC, and let us make this session interactive. You have reversed your input tax credit under 17.5, okay, in financial year 24-25, and now after 6 months you realize that I have wrongly reversed my input tax credit under the permanent reversal column. So the question is, can you reclaim it now as of today when you actually realizes that you made a mistake? Can you claim it? Why? Because the circular is very clear on this, that they have actually released the circular after this format saying registered person will report reversal of ITC which are absolute in nature and are not reclaimable, such as Rule 38, Rule 42, Rule 43, and shall be reported in 4B1. Registered person will report the reversal of ITC which are permanent in nature and can be reclaimed, which are not permanent in nature and can be reclaimed, will be reported in 4B2. So once you have made a claim that that is your permanent reversal under 17.5, how would you be able to reclaim that? So just wanted to understand your thought process. So this circular has segregated. My question, my scenario was that you realizes, not the judgment has come, you have realized it. Of course, if there is a Supreme Court judgment you can reclaim that, of course there is a time limit for that, but the department will say that whatever you have mentioned in 4B1, okay, that is a permanent reversal, which is what they have explained in the circular. But look at their circular itself. They are saying registered person will report reversal of ITC which are absolute in nature and are not reclaimable. For example, Rule 42. Now tell me, is this statement correct? Rule 42 states that you have to first reverse on the basis month-wise calculation, and after the year ends you can either reverse in excess or you reclaim. So is this circular right saying that which are absolute in nature and cannot be reclaimed, for example 42? No. So the circular itself contradicts with the law, stating that 42 reversal is absolute in permanent nature. If I am making a reversal in April, May, June, July and putting in under 4B1, can I not reclaim it afterwards? I can, because Rule 42 allows me, and you are saying Rule 42 is absolute. This is absolutely wrong. So therefore the circular actually overrides the law in that sense, and even if you specify something in 4B1, you can very well reclaim it. The process of reclaim has become difficult because once you reclaim it and it becomes in excess of your 2B plus whatever you have carry forward, it will show as a liability for you. Okay. So, what you have to do, you first reclaim it, then put it in others and then carry forward to future period. In the next month you can again reclaim the same so that it matches your entire figures. Then people are facing issues with respect to accumulation of input tax credit, and they ask me, Yogesh, what options do you have? You can suggest that our accumulation is happening in the state of, let us say, Haryana, we have cash going on in the state of Maharashtra, and there are multiple registrations and we have accumulation. So, there are 5 legal ways you can liquidate your input tax credit accumulation. One is, if you have businesses with different tax rates, you can combine those businesses in the states. If you have businesses with different tax rates in a particular state, you can combine those businesses. Second, you can route your goods through, so there is an outward mechanism and there is another inward mechanism. For example, in a state where you are paying taxes in cash, okay, and in a state where you have accumulated ITC. So, what you can do, where you are supplying to your customer from a state you have accumulated in cash, what you do, you supply it from a state where you have accumulation. So, it will be a bill to ship to transaction. Your customer is located in, let us say, Haryana, accumulation is happening in Gujarat, and earlier you were sending it from Uttar Pradesh where you are actually paying taxes. Now, what you can do, you bill from Uttar Pradesh to Gujarat, ship to Haryana customer, and correspondingly your Gujarat registration will automatically bill to your Haryana customer. By this you can actually choose a value from UP to your Gujarat registration, and then from Gujarat to your customer you can liquidate the ITC which is being accumulated. Similarly, from an inward perspective, what you can do, because this is a bill to ship to transaction, there is no thing like that you have to move from UP to Gujarat and then the vehicle will go from Gujarat to Haryana. No, the transaction will be same, the only thing will be an additional document in form of bill to ship to invoice. That will be the additional document. Similarly, from the inward side, you have accumulation in Gujarat, you have cash flow outward in Uttar Pradesh. Now, why don't you purchase in Uttar Pradesh, file a bill of entry with Uttar Pradesh GST and move to Gujarat, then issue an invoice from Gujarat to Uttar Pradesh to Gujarat. So, this is the second way that you can plan your purchases as well. The transaction will not be any different, the only thing there will be additional one document. So, you can liquidate your input tax credit in those states where it is being accumulated. Another option is export with payment of GST. Some are using LUT for some reason, but by opting this export with payment of GST, you can actually liquidate your input tax credit. And the fifth option is, for example, you have imports and you are going to establish a new manufacturing plant, and you know that there will be some revenue after 1 year or 2 years, and there will be some import of capital goods, huge capital investment which will be imported. So, for a temporary period you can have a bonded manufacturing concept called mover, where you can defer your duties including the IGST till it is cleared. So, for a certain period you can actually defer that particular IGST on import, and that way you can save some accumulation of the input tax credit. Next point is meaning of full ITC. Now, this rule 28 which is pertaining to valuation between related parties and distinct person, it states that the second proviso, that if your recipient is entitled to for full ITC, then you can choose any value. Am I right? Now, what is full ITC? Has it to be seen at the time when you receive an invoice and you just have to check the eligibility as per section number 16, or you will have to consider the reversals also as per section number 17. So, what is the meaning of full ITC? And there has been a circular which states that okay, if you have full ITC, whatever value you want to have, you can have. For example, there was a circular with respect to cross border corporate guarantees. So, you can have any value, you can have 0 value if your recipient is entitled for full ITC. But the catch is that in a good organization or in a big organization, usually no one is entitled for a full ITC. Why? So, everyone is investing in securities. Any company who is not investing in securities, I think even individually you must be investing in securities. So, forget about companies must be investing in securities, mutual fund. In terms of explanation to 42 and 43, 1% of the value, sale value of the securities including mutual fund shall be treated as exempt supply for the purpose of reversal under section 17(2), read with 17(3). So, if you see your books, you will find that you are selling securities including mutual fund which you must have invested for some purpose. Therefore, 1% of that sale value is to be treated as exempt supply, and if it is to be treated as exempt supply, that means there are reversals for common services, and corporate guarantee, renting, any other, these services are common services only because these services impact the entire business including your cash flow which you are using to invest in securities. So, these are common services and you will have to make reversals under rule number 42. Now, if you have to make reversal under rule 42, as I explained, you have to, because in all the organization I have seen this happens, this security is being sold. Are you entitled to full ITC? What is the meaning of full ITC? The entire concept of full ITC or second proviso to rule 28 has been borrowed from the European Union VAT directives, and I have explained here. Article 80 of EU VAT, in order to prevent tax evasion or avoidance, member states may in any of the following cases take measure to ensure that in respect of goods or services supply involving family or close personal ties, management ownership, membership, financial legal ties, that is related party and distinct persons, the taxable amount is to be the open market value, which is the first limb of rule 28. Where the consideration is lower than the open market value, the recipient of supply does not have a full right of deduction under article this. So, that means what it is saying, that you can have the open market value where your consideration is lower than the open market value and the recipient does not have the full deduction, right of deduction. So, here we call input tax credit, in Europe they call right of deduction. Okay. And this is the same language borrowed under rule 28 in a different para. Now, what is full right of deduction when EU VAT says? EU VAT explain that full right of deduction, in addition to the deduction referred to in article 168, the taxable person shall be entitled to deduct the VAT referred therein so far as goods and services are used for the purpose of following: transactions which are exempt pursuant to article this, and these articles are the same articles similar to what we have there under GST as 17(2), where they say if you have exempt supply in your business, you do not have the full right of deduction. Therefore, my point is, if you have exempt supply in your business, which you have and which you have been ignoring, which is 1% of sale of securities, then are you actually eligible for full input tax credit? In my personal view, no. So, is circular actually helping you? No, because circular is only saying if you are eligible for full ITC, have nil value. Have they explained what is full ITC they want to say? No. So, this is the another round of litigation they will be coming. Next is compensation cess. So, anybody importing coal for their manufacturing activities? Okay. And what is, sir, if I may ask, what is your finished product? Chemicals. So, is compensation cess chargeable on chemicals? No. Okay. Now, if compensation cess is not chargeable on chemicals, therefore, so the question is, and you must be having exports, sir? You have exports and you must be claiming refund of compensation cess? Great. Now, so the sir is having exports as well as domestic supplies. They have the input tax credit of compensation cess, and sir is saying compensation cess is not chargeable on the chemicals, aluminium product, steel product, all these manufacturing are going on. However, a new, and department has not used artificial intelligence for this, they have applied their mind. They are saying that compensation cess is not chargeable but is exempt on the finished products. So, if you see the language of Compensation Act, it says compensation cess, there shall be levied a compensation cess on all the supply of goods or services or both. So, compensation cess is levied on all the supply of goods or services, be it a glass bottle, be it a steel product, iron product, chemicals, textile, compensation cess is levied. However, they have carved out that the exemption of the compensation cess is allowed to all the products except these specific products. Therefore, these products, normal products other than sin products, the compensation cess is levied but exempt. So, what does it mean? It means every month you will have to apply rule 42 for input tax credit of the compensation cess as well. And people who are having export as well as domestic supply are usually claiming the input tax credit by clubbing the month, not applying rule 42 for reversal of compensation cess. And that is what the DGGI has started investigation, and superb sort of reasoning from them. So, I just wanted to share with you. Time limit to avail ITC on import of goods. So, just wanted to ask, is there a time limit to avail ITC on import of goods? Anyone? No? No time limit? Why people say no time limit? Because they say section 16(4), which provides for the time limit, uses the expression invoice or debit note. My question to you is, why would CGST Act, which is applicable only on India, and intrastate supply would use a bill of entry in their provision? Section 20 borrows 16(4) mutatis mutandis to say that you will have to make changes accordingly under the IGST Act. But again, there are other arguments to it, but the nail in the coffin is missed by many taxpayers when they say there is no time limit. Section number 17(1)(5), it pertains to allocation of IGST to state and center. It states that in respect of import of goods or services or both made in a financial year by a registered person where he does not avail the said credit within the specified time. So, the law is saying input tax credit on import of goods, if you do not avail within a specified time, that means the law intends giving you an indication that I have specified time. They are not saying times prescribed by rules or something, no, they are saying specified time. That means the law itself is telling you that I have specified the time, you have to locate where. So, you have to read this provision 16(4) with 17(1)(f). Last topic, renting of immovable property. So, now the renting of immovable property is under reverse charge mechanism. Supplier is unregistered, and if your recipient is registered and other than composition, then you have to pay reverse charge. Now, people with power sector where they are actually having exempt supplies, where they are not entitled to input tax credit, okay, and those sectors where they are not entitled to input tax credit, they are having farmer land, solar sector, they have to pay GST. In the power sector, the revenue starts after 1 year, 2 year, 3 years. So what we have suggested and people have actually adopted that for 1-2 years get under the composition scheme, because composition scheme is carved out as an exception here, and composition scheme is actually available to those people who are not making intra power sector. Usually you have PPP with states, so you are not making interstate supplies. Your tax is, electricity is leviable to tax but exempt. So they are saying goods on which tax is not leviable is out of composition, but here tax is leviable on electricity. So that way composition is available. So for the lease rental you will be saving lakhs or crores depending on how much vast your business is. So I have couple of more slides but don't have the time. So thank you very much, and I hope you have liked my slides. Thank you so much. Yeah, thank you.
Thank you, sir. Thank you very much for wonderful session.